Alright, hello, and welcome to Camel Finance. I'm your boy Camel, and if you're here because you want to see how the swing trades are going, that will be in the last 5 minutes of this video. So I'll do a daily update again until I'm flat, so subscribe if you want to see that. In the meantime, today's video topic is funds, particularly with a focus on long-term accounts. So if you are thinking of investing in some funds, if you want to try and benefit from truly passive income, if you want your savings to outperform inflation, then perhaps funds is one option that can help. So before we get into this, please do your own research. This is not investment advice. I'm not telling you what to buy. I'm not telling you what to do. This is supposed to serve as an introduction for people that are thinking about adding some equity exposure or some long-term funds or some investment into their pension perhaps, but they don't really know how. I understand it's a bit of a minefield out there. So this is how I choose funds for long-term accounts, and please remember to do your own research. There are many types and it can seem like a minefield, so that's why I'm making this video. So I'm just going to briefly cover an introduction for how or where you can hold these things, the difference between mutual funds and tracker funds, and some considerations when picking these things. Firstly, you're going to need to know how to hold these and where to hold these, and you have a few options here in the UK. You can hold these in your stocks and shares ISA in the UK. This is probably the most efficient and cheapest way to do so. You can hold them in your pension, and if you've got a pension, you may already hold these sorts of things anyway. A SIP is a self-invested personal pension, and is essentially just the same as a regular pension account, but you have total control over where the money is invested. And another option, there are many more, but another option, the most common one, is keep your money in an investment bank and investment banking account. So this is just, you could go into your local branch or whatever and speak to someone over the phone for a normal bank, and certain mainstream banks will offer investment for you as well. So things you need to consider are the fees mainly. There will be a charge to trade, so whether you're buying or selling will cost in the region of £5 to £12.50 on average. That's in my experience. You typically will get a discount for regular investments, so if you dollar cost average every single month, you can set these accounts so that, say you get paid on the first of the month, and then on the second or the third or the fourth, whatever, a few days after, you can have it so it direct debits straight to your investment account and buys and invest that money into a mutual fund or a tracking fund. And if you choose this option, then they'll often give you a discount, and it can be as little as £2 to invest. There may or may not be an annual charge, so it could be free, or it could be £40, or worse, it could be a percentage of the value of the portfolio. So this might sound very attractive, percentage of the value of the portfolio each year. Obviously, if it says 1% and you only have £1,000 in there, then it might not sound too expensive. But if you are approaching 60 and you have built up £500,000 plus, 1% of £500,000 plus is significantly more than an annual charge of, say, £40 might be, especially compounded over the years. So it's worth factoring that in when you go, as well as the charges for the trades. Some might charge you an opening fee or have a minimum first deposit, so it's just worth keeping an eye out for that. Most of them are not. Most of them, in my experience, don't demand huge numbers. But if perhaps you're looking to open your account with like less than £200, it might be worth just double checking, because I know some of them might demand a bit more than that for the first deposit. The investment arm of a bank will usually want a lot more money to open an account. So if you want to start by accumulating small amounts, then this is probably not the option for you. Some providers will offer a wide range of choice, and some have very limited choice. So it's always worth checking first before you open an account. Some specialise in shares, others in funds, and others in completely different things. So it's worth having a look around and making sure you can find a provider that not only meets your charges requirements and isn't too expensive to keep open per year. You also want to make sure that you can actually access the funds that you are intending to access, because they don't all offer the exact same things. So with all that said, let's get into a few options here. You've got a mutual fund, which is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. And this is the key here, professionally managed. So a mutual fund is active or managed because there are people trading and monitoring and keeping an eye on these positions. But don't be fooled into thinking just because people are managing it, that means you're guaranteed to make money or anything like that. They get paid regardless. They'll just get a percentage of the portfolio at the end of every year, regardless of whether they've lost half of it or tripled it in value. Some of these funds will insist that the fund managers keep portion of their wealth, their net worth, in the fund to try to make them care more. This doesn't always work, but if you are going to go with a mutual fund, it's always good to try to find one where the fund manager is mandated to keep a certain portion of his net worth in that fund, because otherwise then they don't really have much motivation, because like I said, they get paid regardless. So that's always worth keeping an eye out for. These are similar to hedge funds, but hedge funds take long and short positions at the same time every single day to try to remove the risk, try to hedge out the risk. Typically hedge funds are way more volatile as well. So another option would be a tracker fund. And a tracker fund is an index fund that tracks a broad market index or segment thereof. So if you have a tracking fund, a tracker for the S&P 500, then in theory, as the S&P 500 moves up and down, the tracker fund should move in tandem with that. So this is different from a mutual fund because these are passive, they're unmanaged. There's no individual stock picking, there's no hedging of risk. It's just if the S&P 500 is what's being tracked or attempted to be tracked, then the S&P 500 contains 500 stocks, and all the fund will do is replicate that by buying those 500 stocks, and as and when stocks fall in or out of the index, they will just emulate that in the tracking fund. So in theory, whatever the S&P 500 does, if that's what's being tracked, your tracker should replicate as well. It's important to consider fees, annual charges, and the tracking slippage. Okay, so I'll show you what all of this is. The fees will be the entry and exit fees. You'll see that in a second when we get to the kids. The annual charges will be ongoing charges. So at the end of every year, there may or may not be a charge to pay. And then the tracking slippage is the difference between what the index that it's attempting to track does versus what the tracking fund itself does. So if you get the index go up 10% one year, and the tracker go up 9.9%, then there will be a 0.1% slippage, if you see what I mean. So you might be wondering where you get all this information, and all of this information is obtained from something called a KID, and I will show you that in just a moment. The last thing you have to decide is what sort of allocation you want for your assets. So this is entirely up to you, this is entirely individual. You can make this as sort of you can make this as simple or as complex as you want. You can have, you know, a million things in here, or you can have two. It really is up to you. A conservative portfolio traditionally is 60 to 65% fixed incomes. This is bonds and then a little bit of equities. And then you can see as we get more aggressive, the equity portion, that's the stocks, moves higher and the bonds moves lower. So, and then you get to a very aggressive portfolio, which would be nearly all equities and almost no bonds. It's worth noting that this is the typical asset allocation that is recommended for a younger person. And then the closer you get to retirement, the more likely it is that you would scale down on the aggression until you're in your 50s or late 50s, and then you would want something like this. And the reason being is if you've got a portfolio that's entirely in stocks or almost entirely in stocks, then particularly when the markets are doing exactly what they're doing now, you could take out a 30-year portfolio pretty easily in a few months. So that's not ideal if you need to be retiring in the next couple of years. So that's why typically people scale down on the risk so that you don't take huge chunks out of your net worth right before you're due to retire. But when you're younger, you've got the time to sit there and ride it, and therefore it's okay to have a much more aggressive stance if you can tolerate the risk, of course. So with all that said, how do you find a fund? Well, the first thing you need to do is find an account that offers the sort of thing you're looking for, and then have a look through their funds. And when you found one you kind of like the look of, or even don't like the look of, which is when you found, I'd recommend doing this for a ton. I'd recommend absolutely stacking a bunch of these and just going through them so that you can really get a good understanding of what's what and what they look like. But they'll offer these but any fund that you choose, whether it's mutual or a tracker or ETF, so on and so forth, they all have these key documents, and then you can find a key investor information document here, the KID. And so what this is a standard template or nearly standard template that all these funds have. And the reason being is the idea is you could print these out and put them side by side, and then even somebody that doesn't really understand investing at all can come and have a look and make an objective decision based on whether or not this thing is right for them or not. And so these things contain things like the risk and reward. They tell you whether they're typically higher or lower risk. So equities would be considered much higher risk, and if it doesn't hold many equities, if it's much more like fixed income bonds, it would be typically lower risk, that sort of thing. It would tell you if there's an entry and an exit charge. In the case of this fund here, there isn't. It will also tell you right at the start like what the fund aims to achieve and the sort of number of years it recommends you hold it for. It will tell you if there's any ongoing charges. So this particular fund charges 1.13% every year, which is fine if you've only have 50 quid in it at the end of the year, but of course you had £500,000, quite a lot of money to pay. It also tells you that there's no performance fee, so that's good. And then this is that slippage thing I was telling you about. So the fund performance is in orange, and what it's benchmark, what it's measured against, is in grey. And so you can see this fund has actually done really well. It has outperformed the benchmark every year, and significantly it's done way better during drawdowns. Again, you really need to make your own decision on this, and you really need to look through a whole bunch of these, because I just grabbed these three. I've got one here for that tracks the S&P 500. So again, it will tell you at the start, you know, what does it do, what's its aim, is it high risk or low risk, all these sorts of things. It will tell you whether there's an entry or an exit charge. In this case there isn't. The ongoing charge for this one is 0.09%, so that is incredibly cheap, no performance fee. And you can see in the case of this one that the slippage is quite minimal. It's slightly outperforming the benchmark, and it's done pretty well, but for the most part these numbers are more or less the same, so there's not much slippage with this particular fund. And that would be an S&P 500 tracker. And then I've got one here just to show you that this iShares UK dividend. So this is a slightly different one to normal. We'll have a look at the kit for this. And what this aims to do is to invest in all of the highest yielding dividend stocks from the FTSE UK dividend index, and then try to track or outperform that. So it tells you that, again, it's quite high risk because it's equity based. Entry and exit charges are none. Ongoing charges 0.4%. That's reasonable, I think, with the 0.9% being incredibly cheap from earlier. That's 0.09%. That's very cheap, and I would argue that this one 1.13 is quite expensive. But I mean, again, it's for you to decide. That's just my opinion. This is for you to decide. So 0.4% seems about reasonable. And then you can see the fund versus the benchmark. So this one is underperforming slightly and suffering worse drawdowns during the drawdowns. So that's just three examples. One of a mutual fund, one of ETF tracking the S&P 500, and one tracking a dividend index. So you need to make your own decision. I'd recommend that you look through a whole heap of those. Make sure you do as much research as you possibly can. Once you've seen a bunch of those kids, you'll get really familiar with them quite quickly. They are designed to be for people that have no investing knowledge whatsoever to look into. So the standard template does make it quite easy to see. So just to recap, you'll need to pick a place to hold these funds. Then you will need to make sure you've considered the fees, make sure that you're happy with paying the trading amount, make sure that if you're going to do dollar cost averaging every month that you're happy with that. Make sure the annual charge is acceptable to you. Make sure you can afford any minimum first deposits. Then decide how much risk you want to take and how much money you can afford to put into each of these types. And then it's a case of sifting through all of the funds and the kids that your provider offers and making a decision based on what seems right to you. So let's wrap up today with the trading portion of this video. The dollar, has this put in a high? Is this the high? I'd like to say yes, but I'm just not convinced yet. Could I see a double top or a lower high? That would be preferable. Can I see a higher high? Everything's on the table. I do think we're a little bit early yet, but this is the first sign of weakness we've seen from the dollar. It is likely just a pullback for now, but we will see. The S&P 500 still in for now. The futures are up around 1%, so will we start to get a bounce out of what looks like it could be attempting a double bottom? Maybe. We'll see about that. Gold is back inside of this thing, so that is for now good to see. I really wanted to see that. As I mentioned in some prior videos, I said I wouldn't be able to tolerate hanging around underneath this blue line for too long, so it's good to see we're back above that for now. Silver is on its way up, but not looking super strong at the moment. We'll see how this goes, but we're in. That's the main thing. And Bitcoin is hovering back around 30,000. Let's move this out of the way. So we're back around 30,000, still hanging in this green box. If it keeps doing this, then the argument for this fractal repeating from over here becomes stronger and stronger, in my opinion. So we shall see. We'll keep an eye on this. If you found value here today, I'd appreciate it if you could subscribe to the channel. Follow me on Twitter. If you want to see me continue to deal with these wild markets, continue to swing trade through them during these wild times, make sure you subscribe, turn the notifications on so you don't miss that. I'll be updating every day. And until tomorrow, take care. All the best. Bye.